We're snorting cap rates and shooting up cash flow here at Deal Junkie. Welcome back to Deal Junkies, a real estate podcast. I'm Gabe Johansson. I'm here with my co-hosts, Trevor Howard and Dane McKinney. Today is a very special episode we're going to record for you. We have a special guest in the studio today, Mr. Logan DeVos. Logan is probably the most brilliant real estate mind, at least in this room, I would say, and probably the most brilliant real estate mind I've ever met. Current CEO of SMI Fund Management, and has a wonderful story to share with us today. Welcome to the show, Logan.
Thanks, guys. Appreciate you having me here.
We're gonna have fun with this one. So I don't know where to start, but I know Trevor's gonna want to talk about deals and how to put deals together, and we can do all that in a minute. But first, I want to get into the mind of Logan DeVos and find out, where did this all begin? Trevor's already going to ask about a deal.
Before that, just tell us a little bit about like who you are right now, so people have.
Oh, you want to know about him right now?
Right now, like what are you doing? Like, what's your portfolio look like? Just high level overview.
Okay.
So then we'll dive backwards.
All right. I'm. Let's see. Right now, so on the real estate front, I'm a private investor. I started in single family homes,
get a little
multifamily. Get up closer to this thing. All right. Okay, so let's see. I'm 36 years old. I now have a wife and 2 kids, so I'm enjoying a new phase of life. On the real estate front, I'm invested in multifamily, retail, office, some light industrial, some developable dirt. Let's see, Gabe. We own a lot of stuff together. Am I forgetting any real estate asset classes here?
He's a deal junkie, is what he's saying.
Well, no, just to give people a perspective too. You've purchased over like $50 million of real estate, right, within your portfolio or something.
Yeah,
crazy.
yeah. Total purchase is a lot higher than that. So my current portfolio is a little bit over $60 million. Now I only own half of that in my real estate holding company. From day one, I've done most deals with partners. And I'll differentiate partners from investors. So investors, I think of passive people, individuals that give you money, ride in your deals. Partners, I just think of as a partner that you're doing a transaction with. So an opportunity to diversify, participate in more deals, get more minds in there. I find for myself, sometimes it's easier to be more accountable to a partner than it is to yourself. Call it a anchor weight to being a deal junkie. And,
brake pedal.
Yeah, brake pedal. So so I've just played, I started with a single family home and have just played the game of consistently going after new inventory, one property at a time. And then we do the regular real estate 101 and upleg those into bigger things and diversified into different real estate asset classes. Small steps at first, but then you start to get comfortable with that product type, self-storage or retail or office. And so kind of slowly grow it out. Certainly maintain a backbone predominance in multifamily. So I'd say probably 60% of my portfolio is multifamily. And
I just want to give perspective to show like he's in his mid-30s and bought an insane amount of real estate compared to most people. Now you can get into whatever you want.
Well, real quick before, because I want to go into obviously why you got into it, where you started, but how many 1031s have you done?
Oh boy,
it's a pretty high number.
We did 9 on one deal just a couple of years ago.
Yeah. Well, yeah, 6 forward, 3 in reverse. That's the most I've put into a single transaction. It's nine-legged exchange, and I would say that I've probably done at least 50 1031 exchanges. I'm kind of thinking this through in my mind right now, but typically when I'm buying at the bottom of the barrel, which would be, an asset that we fall in love with, a value add property, and they tend to be smaller, lower hanging fruits. That's not a property that we're repositioning equities into. It's just something that we're going after because it's there and we can swallow it. There won't be an exchange involved in that. But other than that, we're repositioning equities. We're equity trading. So we're looking for equities that are going to outperform the equities that we currently have. And so then we, I'm always focused on where's the next deal? Where's the next opportunity? That's first and foremost. Once we find that, we know we want to buy it. Well, first we'll lock it up. We'll put it in escrow and we'll commit to closing quickly. Then we'll go back to the deal table and say, all right, how do we buy this? This is a good deal. So then we look at our portfolio and say, well, what do we like least? What equity is ready to move forward? And so circling back to the 1031 exchange, almost always there's 1031 exchanges involved. And if there's time to sell a property before we need to close, it'll just be your standard forward delayed exchange. And if there's not time, which is often the circumstance, then we figure out how we're going to get it closed. And then we buy ourselves a 180-day window post-closing to clean up our portfolio and transfer those equities and accomplish it through a reverse exchange.
One of the things I've learned from Logan is how to build a runway. So when you say you lock up a deal quickly, you're not closing on a deal quickly. You're locking a deal down quickly with aggressive terms, but building enough time to go out and move the equities around. So if you're going to be an equity trader, the difficulty is well, now we've got to identify what the down leg's going to be. Now we've got to try to sell it, and we got to line all these timelines up. And so you can't go in and say, well, we'll close in 30 days or 60 days because you're going to have to go move all these pieces around. So Logan will say, I'll give you a great price, or I'll give you great aggressive terms, or we'll go non-refundable on earnest money at, after due diligence, but we need a 6-month runway to get this thing done so that we can go move all the pieces around.
We hear a term in real estate, cash is king. And I don't think that is correct. Commitment is king. When you're a seller, you're looking for the most committed party. Cash is often perceived as most committed because there's one less party, the lender, that needs to make a commitment or could back out of the deal. So we found a lot of success in being the most committed party without being the party that's necessarily going to close the fastest
or pay the most. And but each deal is different. Sometimes you have no choice but to close a deal out quickly, and other times you can go stronger on your commitment into the deal, give the seller what they need in the next 30 days, but then negotiate for a 3, 4, or 5 month runway, as Gabe says, to get the deal closed. Yeah, Logan, as you can tell in the first 5 minutes, he thinks on a different level than probably the average brain. I know mine. So I tend to be Logan's translator. When he comes and speaks to our brokers, he says what he's going to say, and then I have to tell him, okay, in English, that's what this means. So let's go back. We want to get to know Logan. Like, Trevor got what he got. Now Trevor can take a nap for a minute, Trevor. I want to go back. You talked about buying a house, but before then, I want to go way back. I want to go back to your youth. It sounds like you have a partner in your real estate holdings. Like, at what point did you know in your life you were going to be entrepreneurial, that you were going to like having partners, and where is sort of the impetus? Where's ground zero? Where did it start?
Sure. Yeah. Well, first and foremost, my number one partner is my older brother, Trevor. So we've been partners. Not only are we still partners in real estate, but we've been partners dating back to a fairly early age. So we started as employees. I think I was probably about 7 years old. I was in 3rd grade, so I lose track of how old you are at what grade. But
you were probably only like 4 in the 3rd grade. But
yeah, well, I was getting paid $1 a day, so that was the going rate. So was my older brother, Trevor. We got paid $1 per day to help my mom with her chicken business. So chicken business. So we lived on a small farm in Philomath, Oregon. We had 500 free-range chickens. Crap everywhere. These are truly free range, not just legally free range, but they're free range. So they hang out on the cars in the barns, all of that. So we were selling the eggs. And so we got paid $1 a day. Got to collect the eggs. You got to wash them every once a week, and you got to shovel chicken shit out. I think
You wash the chickens or the eggs?
Just the eggs.
Oh,
just
okay.
the eggs.
All right.
So then my brother and I, we wanted to take over the reins. We saw my mom was getting a pretty good deal here. We're getting $1 a day, $30 per month, which, mind you, was pretty good money when you're in third grade. I had a lot more money than my friends.
Yeah.
$30 per month. So we didn't get an allowance though. And so we decided we want to take it over. So we bought, we had been making $30 a day. So we got enough money. You could buy chicken for like $1 each. And so we bought 200 chickens or 100 chickens, I forget. And but then you got to go through.
At 7, you bought 200
It takes
chickens
like
when you're
6
7.
months before they're laying any eggs. You got to feed them, and all that stuff costs money. So now, in my mom's fairness, parents' fairness, she didn't charge us any rent to use the barn or the chicken house. So you can't get it 100% right out of the gate. But yeah, so we got into the chicken business. We experimented around with that. We tried not feeding them for a bit because we saw the expenses were out of control. Led to massive drop in egg production. Almost lost one of our retail trade partners, because we couldn't meet the quota. If you can't give them the eggs, they're not going to buy them. So, my mom and my dad, they were pretty good. They just let us kind of play that out a little bit. So we got burned out on the chicken business. We did it for like 3 or 4 years. And
So you retired at 10 years old?
Yeah, we retired from 10 years old. My mom also helped launch our second business. She's a dietitian and a nutritionist. She taught at Oregon State University, Lynn Benton Community College for years. So she taught part-time, raised the kids part-time. And she was a dietitian, so she taught nutrition. And we always had kind of not really a joke. We'd say it jokingly, tongue in cheek, but you're better off in our household getting caught with drugs than candy. Like, I got in less trouble when I was in high school and my mom found some pot than I did when we had snuck to the store, bought a bunch of candy bars and kept them on the bed. So my mom and her mom were going to China for a summer. And my dad, he worked full time. He owned a real estate property management company, actually. He was partners with Forrest P. Bowman, and it was Forrest P. Bowman and Company at the time. And then we also had this kind of hobby farm. It was 400 acres though. So middle of the summer is hay season. So my dad's pretty busy with hay season. So we had to live in babysitter for the summer. And I remember I'd just gotten back from outdoor school. And so I think that was 5th grade or 6th grade is when you do outdoor school. So my brother and I, we got this great idea because we got a catalog called Oriental Trading. I don't know why we got it, but it always came to our house, and you can buy all kinds of candy, bulk candy in the back. So my mom's gone for the summer. So we buckled down. We bought like $300 worth of candy. It took 2 weeks to get here. It probably took like 3. We might have ordered it before I went to outdoor school, because I remember we were just waiting for it to get here. And so UPS finally shows up. We got a huge box of candy. We had this shed on our property that was considered my playhouse. So it was a Christmas gift when I was younger. So it's just a shed, but I'd always wanted a playhouse. My brother and I, we set up a candy store in it. And we had 2 customers, my younger brother and my younger sister. And our family was always kind of money, like it was part of our growing up money. So all of us were doing different chores. We had different things going to get, we cleaned them out in the first week, and they spent all their money. We opened each day for 10 minutes per day. And this babysitter and my dad both got wise to it, but they kind of played dumb because everybody was towing the line. Barn and Joy are asking to do chores. Normally the going rate might be like $2 to do this or that. They were willing to accept a quarter. And they'd give my dad shoulder rubs, try to make a little bit of money there. So we moved from the chicken business into the candy store business. Market exhausted all of their capital within 30 days. So, and then the ants actually ate the rest of the candy. So we shut that down.
So then you retired from the candy.
So we retired from the candy business. My brother and I had become avid paintballers by this time. So I was in late middle school. My brother had started high school. And so we would host paintball games. We had a great setup for it, living on 400 acres. And it started out of just the laziness of all of our friends. They were never organized. They didn't have their paintballs. Somebody had to get CO2. And so first we used to just do it as kind of a charity. We'd buy it all, and then they, our friends would reimburse us. And then we started marking it up. We're like, we're doing all this work. We charge 15% more, and then we don't have to pay, we get ours for free. And so we did that for a couple of years. That was fun. We created quite a paintball community in Philomath. We got it so large that in high school, and it was for my older brother's senior project, but we started a paintball store in Philomath, and it grabbed some traction, and we would host games out at my parents' farm in Philomath. We started doing birthday parties and bachelor parties.
How old are you when this is happening?
So I was 14. My older brother was...
You opened a store when you were 14 years old.
Yeah, and it grabbed some traction. We ended up moving to Corvallis. We opened a bigger store in Corvallis on 9th Street, and we opened a couple of playing fields. So we partnered with Scotco Trucking, who owns some land in Philomath. We ended up partnering with the Corvallis Sports Park for a while. We did indoor reball, which uses paintballs, but they're rubber, so they don't leave a mess. We rented an old World War II building in Dare, Oregon, 40,000 square feet per floor, and we rented the top 2 floors, and we would host airsoft games there, actually. And we would host these big organizations, airsoft organizations that would come in. We were more kind of like just the host, providing this cool facility and running it. And so we had a lot of fun with that. We started a West Coast paintball tournament series. So we hosted, where teams come and compete. We did it down in Southern California at a place called SC Village, and then we had our playing fields, and we rented some playing fields. Actually, there used to be one here in Kaiser that Dan Bonebreak owned.
Over by
great paintball mentors. Yeah,
Chemawa Indian School area.
Bonebreaker.
Is this the one off of I-5 right over here?
Yeah, exactly.
I played over there.
So, and actually in high school I got, paintballs are, the manufacturing process of paintballs is actually pretty intense. It's made in the pharmaceutical industry using encapsulation. So the same technology that designs your pills is what they use to make paintballs. It's super expensive process. And so there was a company, Nightcap Paintballs, and they had their paintballs manufactured at a high-end facility in Ireland, and I ended up landing the West Coast distribution contract for Nightcap Paintballs. So we used our West Coast tournament series to help promote the brand. That's how you get it into the team's hands, and you're creating relationships with the folks that own the stores and the playing fields down there, because most of them have sponsored these various teams. And it was kind of paintball was interesting because it was a bit of talk about a cowboy industry. There was not it. Everybody was a bit of a Yahoo. I'm talking about all the folks even the folks that own the big companies, Smart Parts, Tippmann. It was just hobbyists really that hit it as the industry.
So you landed this distribution. You're still 14, or
I was like 16 at this time because we ran it for a while. In fact, it was kind of funny. So the guy I remember Jody Polanski. So he was the owner of the company. He was out of New Jersey, and he kept trying to get me to go to the big distribution industry get together in Las Vegas. He's like, you got to be there, and you're doing such a great job promoting it over there and stuff. But I was like, why can't you go there? So I never told him that I wasn't 18. Like he didn't really know how old I was, but I couldn't go to Vegas for a week hang out. And
you had school.
Exactly, at school I couldn't be reached between 9 a.m. and 2 p.m. because I'm at school. I remember sneaking out. Actually, my teachers were pretty good and stuff too. I had a health class because that was one of my early afternoon ones, and that's when I'd need to drive to Salem to buy supplies for our store, so that I could sell them after school when we opened up. And so a lot of times I remember go tell my teacher, like, I really got to go 30 minutes early. I got to get to the bank and get money out. And so they were it was a good school system that I went to. They were fostering of our business.
Yeah. How'd you do that at 14? Because don't you need to be of legal age to like rent like a space to open a store and do different things? Well,
you're hitting on the topic of capacity, right? So you need to have capacity, and one form of having capacity or one necessity is being 18 to execute a contract. But you can execute the contract. It's voidable by the party that doesn't have capacity, right? And specifically to being underage, it's still an enforceable contract. It's just one way enforceable. So I could void it. But the other part, now we didn't, I'd say this kind of tongue in cheek. We never looked at it that way. In fact, I don't even think I knew that concept until after I was 18. But
So how much money were you guys making? Because this sounds like you grew this pretty big. Like, were you making serious money when you're at 14, 16?
serious for a 14 to 16-year-old. In fact, I remember, my friends would kind of laugh because we're going to go do something for the weekend. It's like, I got to drive by my store real quick, open up the cash register and just grab a wad of cash. Like it was partly our, that was like our bank account, like how much cash is in there. And we were operating it to the level of sophistication that a 15 or 16-year-old is going to, which is a much lower level of sophistication. So like the way that we would gauge how well we were doing was how much inventory do we still have in the store relative to how much cash we have. So you got no inventory, but a ton of cash. Okay, you're still doing good. We just got to go buy more inventory. Inventory's getting down. We don't have that much cash left. All right, we haven't actually been doing all that well the last few months, and we're not recycling it back in. So but yeah. So for the age that we were, we felt like we had a lot of spending money. But if I was my age now, I'd be in the poverty level.
But how many 15-year-olds do you know that are out picking up West Coast distributions and starting?
Now one.
It was a fun experience.
This is my first one.
It was a fun experience.
It sounds like the best time to start a business, though. Yeah. Because you can just get out of every contract that you get yourself into.
So this is awesome. Tell us, when did real estate enter the picture?
Yeah. So I graduated high school. I was going to take 1 or 2 years off so I could wind down our paintball business. Close it up. And then I was going to go to Portland State University in marketing. That was what I thought I wanted to do and what my plan was. And so I'm out of high school. I hadn't gone to college yet. So there was a local coffee shop, Java Connection. They had a branch in Corvallis, a branch in Philomath. And Philomath is where I grew up. Corvallis and Philomath are almost like the same community. You can almost call Philomath West Corvallis. It'd be better for the property values if you did. But so I started working at this coffee shop. It's all young college age students working there. So a bunch of my buddies and I all did. We went and applied. It was kind of fun. We needed the spending money, but it was also just part of our social life. And I ended up getting one of the customers there, one of the regulars, husband and wife, Abigail and Scott Basson. They owned the Philomath Remax. And so I had become kind of friendly with them, and they asked me to come work for them. They did residential real estate, and that's where I got started. So I started working for them. They kind of created a job for me because they already had a transaction coordinator, but they owned about 15 rental properties, and so I helped oversee that with them, serving notice to tenants, visiting at the properties, and then you have turnover. So as staff are coming and going, then I'd be able to grow and start taking on other duties. Started doing transaction coordination, and about after the third closing, I wasn't brokering it, but the brokers hadn't even really met the principles. We got to get you licensed. You can't. So I ended up starting the process. I went to the Norman F. Webb School out of Salem here, got my real estate broker's license. I was working one of the areas because I did enjoy marketing. So I was working with Scott and Abby. We rolled out some good direct response marketing campaigns. Granted, this was 2006 and then the first half of 2007. So we were in a different cycle back then. This was pre-recession. So marketing campaign, it was pretty easy. Learn how to get paid $30,000 by the bank to buy a property that's going to go up X amount, per year. So but we were successful in that campaign. We were getting all kinds of leads. So I started doing a lot of marketing, direct response marketing work for them. And then after I got licensed, I kind of fell in love with the idea of moving up to Portland. A bunch of my friends had been moving up there. And so I moved up to Portland, interviewed with a couple of outfits, joined Equity Builders Realty and was getting started as a real estate broker.
Your dad never tried to get you into Forrest P. Bowman into property management when you were a kid?
So my dad, no, and I got I'm not giving credit where it's due. I got a lot of exposure to real estate. I watched my dad in the property management business, and then property management was how they created their salaries, but he and Forrest did a lot of deal making themselves. They were investors. They were invested in Oregon. Again, apartments. They were apartment guys. They had gotten into Texas, so they rode the Texas market through several cycles. Texas has a little bit more, and as he always explained it to me, of it follows the traditional real estate cycle a little bit more than Oregon. The
boom and bust cycles.
Yeah, boom and bust. Well, yeah, overbuilding. Expansion cycle. You're gonna oversupply, and Oregon is interesting because we're insulated to a certain degree. We've got full exposure to the economic cycles, but Oregon is one of the most difficult states to build in. Our land use planning laws are so strong that even when things are hot, market has a hard time keeping up. Even getting it in, it takes so long to get a shovel in the ground, and we got less than 3% of our dirt is buildable. But in Texas, and you see this when you look at market cycles. So you look at the Great Recession, Nevada, Arizona, Texas, markets that were actually way overbuilt. So we came in and they actually had excess inventory. It took years to absorb. Whereas Oregon, we're hurting, but our vacancy peaked at 7% for one quarter, somewhere around 2009. So, different type of volatility, not the same level of volatility. But I ended up, so my dad and Forrest had passed away about this time. But a little bit before that, my dad and Forrest sold their Forrest P. Bowman to my dad's brothers, Mark and Peter, and it had subsequently been renamed Investors Property Management Group. And it actually from Portland, after I was playing around there, I got this great idea that we should add a brokerage arm, real estate brokerage arm, to Investors Property Management Group. So I teamed up with them, helped take the lead on that, and
so IPMG, like in the South Valley, that was, you guys were probably the biggest property management player in the game back then. They
were headquartered out of Corvallis, and I think at the peak, at least the peak of IPMG, so pre my dad and Forrest, I think they had around 3,500 doors.
Okay. Big company.
A lot of it in Corvallis, but then they had a branch office in Salem, branch office in Eugene, and so as far as property management goes in the Willamette Valley, they were one of the big ones.
So when you decided to bring a brokerage to the IPMG model, you started your own brokerage at that point?
That's correct. Yeah, we spent like 6 months under IPMG, and then we rolled out Commercial Realty Professionals.
Okay.
And part of the idea, I really liked the commercial and investment side of it, and part of that was getting under mentors, that were in that field and getting the exposure of it. But there's a symbiotic relationship between property management and brokerage, because symbiotic relationship in the overlap of the clients, right? So there's a lot of opportunities to represent management clients when they're wanting to exit the playing field, as well as when they're wanting to grow their portfolios. So we tried to farm that client base and let them know that we're doing real estate brokerage, and we got a number of leads and transactions out of it, and it was successful to a degree. I ended up taking, kind of finding my wings and learning what I wanted to do in commercial real estate brokerage, and it was much more on the building out portfolios. And over a period of time, I kind of just transitioned into building out the clients that I work with that ultimately became, my partners.
Yeah.
We did deals together, and so here and there get a good listing from IPMG, but mostly it was just working that.
Yeah.
So were you building out their portfolios before you had bought anything yourself at that time?
Yeah. So first I was, exclusively real estate broker. And my brother and I were, swimming, like I said, I started with a single family home. In 2009, you're buying a single family home in Lebanon. I think my first deal was $43,000. So very different price points as compared to today. And then you're talking about a top to bottom rehab that adds another $22,000. And, but it's all relative. I mean, rents were $900 for that single family home. And so I would often, because I was focused on the investment side of it and understanding the economic benefits that are offered through the real estate. And so with my clients, I would, use some of my properties as an example, in this duplex and this fourplex and this house over here. And so I was brokering for them. And then, they were motivated to have me involved in the deals, and to do not only have me involved in the deals, but, participate in the deals that I wanted to do. And so it allowed us to do larger deals together. And, on my left hand, I'm creating brokerage fees out of it. So it's nice if I can do a larger deal, I'm going to get a bigger brokerage fee, and that's what I live off of. And then at the same time, I'm creating my foundation for equity.
Yeah. So when you were doing the deals with them, were you pitching, like, how were you doing it with them? Were you bringing your own money? Were you pitching your fees in the deals, or were they just giving you a piece of it because you knew so much about structuring and analyzing a deal?
Yeah, each deal was a little bit different. So again, it was partnership relationships. So I didn't charge, I'd make a brokerage fee, but everybody it was apples for apples as far as contribution in, contribution out. And our, like with the houses, with that first house, most of what I learned in real estate, I just learned through trial and error, and how do we keep moving forward. And so, when we bought that first house, we're going to flip it. Like everybody's going to flip a house. And I can tell you, this was a different environment for flipping homes. If you want to learn how to flip homes, do it when the market is consistently going down. I lose track of the timelines a little bit, but from 2008 to around 2013, the market was in a steady decline. Like the bulk of the volatility came in up front. That's where the market repriced itself. But then it was continuing to decline. So today, somebody goes out to flip a home. All right, I'm going to buy it for $100,000. Put $50,000 into it, and I think it's going to be worth $200,000. So you got to do the same analysis in 2009. But if you think it's worth $200,000 when you're done, but it's going to take you 6 months, well, that becomes $190,000. The market is consistently going down, so it's working against you. It's a lowering tide, not a rising tide. And so we renovated the home. We got it looking nice, and we brought it to market, and we actually went under contract fairly quickly, and then we had our first sale fail on that. And then we decided, okay, well, before we come back to market, we're looking at what the properties rent for. And we were in a real inverted environment. It was part of, you can tell that you're in a down market. A homeowner could buy that property in Lebanon, and they're, putting 0% down or 3.5% down. Their PITI, principal, interest, taxes, and insurance, was going to be around $650 per month. Or they could rent the home for $950 per month. So that's a large delta. And it's an indication that the value of the property is depressed. We could also see that, hey, if we can get that mortgage on it, we'll positively cash flow $300 per month. So we went through that exercise. We have it appraised out. We hit appraisal, close. I think it was a little bit under where our sale fail price was. So we followed through on that. We did the refinance, then we put a tenant in it, and the property, we had purchased it using a hard money loan, right? So we had an expensive loan on it. We're trying to flip it. Then we complete this refinance, and all of a sudden the property is cash flowing, and our portfolio is one asset, but the portfolio is stable. Yeah. So then we want to go do it again. And I think the next property we found was a duplex.
Did you want to flip that one, or did you want to, like, you discovered how to buy and hold them and you wanted to do that again?
Yeah, our goal, my brother and I, Trevor and I, we knew that we wanted to build out a real estate portfolio. Flipping it wasn't, this wasn't going to be like a business that we were going to run. It was just we needed to create some capital. And the first deal, okay, we'll flip it and then we'll have some capital. So once we had taken the first asset all the way through, I learned all the hard lessons, I think, just live. Now I see they've got all these books on the BRRRR strategy, BRRR, buy, renovate, refinance, repeat. And that's exactly what it was. So we saw that live and we liked that formula because we didn't have families. We didn't have any overhead. My brother and I had bought a 5-bedroom house in Corvallis that we both lived in. We bought it for $199,000. We financed it, I think 100%. There was a special tax credit going around at that time and down payment assistance. And my ex-girlfriend, now girlfriend at the time, she bought my brother's car so we could meet the liquidity requirements and all that. Like, it was a song and a dance to get there. Yeah. But and then we room shared out the other 3 rooms, so we had kind of a fun environment there. And so we had no overhead, and so the BRRRR strategy was appealing to us, and that's kind of how we proceeded forward on the next deal. So we look for them, and again, these deals are $50,000 to $120,000, and one challenge we found was that anytime you come to market and you strike out, you create a high water mark on your valuation. So we were always a little bit shy because we go through this kind of thought process of, hey, we could sell this for $150,000. We'll be happy with that. We'll take the cash and we'll move on to the next one. But if we can't, we'll be happy doing a refinance on it and holding it. But you had to set the bar a little bit too high, which is, as real estate brokers, that works against you. It cuts down. The market's efficient, so it doesn't look around for overpriced inventory and then what would it buy it for? It looks for the best priced inventory. And so we'd play that game a little bit, and some properties we would sell, but the majority of the time and our goal was to complete the rate term refinances. And we got smart because it was the financing environment was really tight in that time period. And so I would take on all of the hard money loans, and my brother was the perm borrower.
Smart. Yeah.
So in that, and we disclose everything to the lender, but there was a way to structure it to be helpful because of the debt to income ratio that residential lenders use. And if a property is in an LLC, after 2 years, once the borrower's got 2-year tax returns and K1s, residential lender just uses that K1, so you can get away from the debt to income on that. And so we'd set it up that way. We created an LLC together. We'd keep the expensive debt on my books, and we'd keep the efficient debt, the permanent debt, on my brother's books.
Was that him giving you the bad debt just because he was the older brother and if it went bad, he wanted you to have it?
No, it's because my brother made more money. I was a real estate broker. I couldn't get financing, period. So I might as well. I couldn't get it from a convention institution. Yeah, and because I was on 1099 income, and it frankly wasn't very much to start with, and it wasn't consistent. So I'm earning brokerage fees off of $50,000 properties, $1,500 at a time. And my brother worked for a startup in Corvallis called Perpetua, and he was actually making pretty decent money for his age and the time. So we had a good W-2 to work with, and we allocated him as the perm lender.
Okay. So how many times did you guys do this before you transitioned to multifamily, or what led you to that?
It was just a steady progression, meaning when we sold the single family home, we bought probably a duplex or a fourplex. And when we sold the duplex and fourplex, we bought our first multifamily property that was more than 5 units. I think around 2013 is when we really broke into the 5+ units. And you slide into a new category because you're moving over to a commercial lender versus a residential lender that can facilitate, 2 to 4 loans. And there's pros and cons to it. There's a lot of pros because the commercial lender is much more of a real person that you can negotiate and can analyze risk and reward for themselves. Whereas a residential lender, particularly after Dodd-Frank, it was a giant automated machine. The loan officer doesn't, they talk about underwriter. The word for it's a loan analyst is all they're doing. When you're dealing with a conventional loan, they're making sure that all of the requirements have been hit and the boxes are checked, but there's not really a machine actually literally decides. They plug it into an automated machine. And it was these early teens, 2011, 12, 13, that automation was coming in. And now it's pretty much exclusive. Like I remember looking at a residential loan with a lender maybe 5 years ago, and there was no option. Like, well, if we can't get this thing to give it an automatic approval, and I was like, you can do a manual underwrite, and I've read the handbook. I can walk you through it, but that was new, so it's very, very rare for an actual manual underwrite to be done now.
So, how did you learn you could negotiate with banks? Because I've seen you do it, and you were the first person I ever saw who was like negotiating actually with the bank. Most people just take the term sheet and they're like accept or reject and move on.
Yeah, working with banks is a bit of an art and a science, but there's a lot of room there. Main Street banks, commercial banks, their loans are their product. It's what they're selling, and it's a unique industry because you've got, the greed and risk all wrapped up into the same product, right? So they're greedy, they want to do the loan, but then there's a lot of risk tied to it, and it's a big consequence for a bank when a loan goes sideways. So we certainly started in the category of always marching towards trying to figure out how to get an approval, right? Like beggars can't be choosers. So how do you get the loan done? And with a commercial lender, it's kind of a big switch because getting started is the early stages are hard because the underwriting criteria, the sponsor, the investor, I'll use the word investor instead of sponsor, the investor's experience in real estate, in market cycles, dealing with volatility and dealing with the type of asset is much more important. It's very important to the lender. When you're applying for a residential loan on a triplex, you don't need to build out a biography that says how much experience you have in triplexes. They don't care. It's how much is down. What's your debt to income ratio? What's your credit score? But with a Main Street loan, that sponsor experience is really, really important. And so getting, your first few loans in that category are trickier. I learned through experience, and then I've also read literature on this. It's one of those things that gets much easier as you go because you become much more desirable to the lender if you do have experience, if you fit all theirs. I guess going back to that kind of greed and fear ratio with the lender, if you're a proven commodity and you keep your portfolio and your books and your operations in order, you're a customer that they want to work with. They've got a certain amount of debt that they want to put out, and if they call it like a rating system, if you're in a A-rated borrower, they would much rather get aggressive and negotiate, get more competitive, I should say, to land your business than they would to make a little bit more and go out to a unproven product, if that makes sense. Yeah. And I'm kind of thinking out loud here. Dealing with private money lenders kind of gets you in the correct mindset because it's much closer to home, and you start learning how much of it is actually presentation and negotiation, and but that slides straight across to the commercial lender too. So, and finding out what they need, it's definitely a two-way street. Like by no means do our success and my success in negotiating loans, it's not strong arming any lender. It's finding out what they need to be comfortable, what they need to feel profitable, and figuring out how you're going to give that to them while getting what you want out of it.
Yeah.
And it's just like negotiating a real estate deal. Like there's a lot of times, how do you get the price lower? How do you get more time? Okay, you want 6 months to close. You got to give me $100,000 in non-refundable earnest money. Win-win.
Yeah. Could you give us an example of like a negotiation you have done with the bank, just so we have perspective on it?
Sure. I'll do a more recent one because it's going to be fresher. So first quarter 2022, I closed on, Gabe and I, Gabe's my partner, on this deal. We closed on the Vicinity Apartments in Corvallis, formerly Campus Villa. So it's actually the largest deal I've done. Is 101 apartment units immediately contiguous to the university. This is the transaction I had said we did a 9-legged exchange on, 6 forward, 3 in reverse. And so we consolidated assets and partners. So those assets all had partners in them. So I invited those partners to come along, and we again affected consolidating the assets and the partners. And then we negotiated with a local credit union that we'd worked with. And so getting into kind of the loan structure. So this was first and foremost a value add deal. This was a vintage product built in the 70s. Amazing location, good unit mix, 1 and 2 bedrooms. That's harder to find in Corvallis, which is representative of a lot of university markets, because in order to maximize the density, developers and builders are taking down 1 and 2 bedroom product that's built in the 50s, 60s, and 70s, and they're putting up product that's got 4 and 5 bedrooms in it, because the zoning code might say you can only have 5 units. But if you've got 5 bedrooms per unit, in university towns, that's like having 25 units. They're leasing them by the bedroom, $900 a bedroom. And so I really like the traditional unit mix because it's in high demand. It's been being taken out, and there's still a lot of folks that don't want to live with 4 unrelated parties. But it was a big deal. So it's a value add asset. We're wanting to renovate the units when they turn over. We're wanting to, average rents, let's say in the marketplace for 2 bedrooms are around $1,400, and average is this. I think investors miss this mark a lot. Not all units are average. So if you're new construction, if you're delivering new inventory to the market, you're typically hitting the 95th, 100th percentile, or pushing it to 105. If the most recent new deliveries are renting for $2,100 per month, you're moving forward under the thesis, I'm going to get $2,250 with this top end product. So, a value add reposition is often taking an asset. Sometimes we'll target a property that's below average, and we're going to bring it up to average. We're going to fix the deficiencies and bring it back to median or average rents. I like that category because there's a lot of takers for average. There's a lot of residents that want average, and we're in an affordability crisis, and average is a good spot to be. But when you have a geographic location, that really drives your capacity to position above average first, irrespective of what the asset physically looks like or what you can make it physically look like. It needs to be located in a spot that above average residents want to live. And so this property was perfect because it's right next to the university. It's got good bones in the sense that it's got a good unit mix. It's 70s vintage. That's easy construction to work on. Things are still square. You don't run into nearly as many surprises. So that was a lot of backstory for the fact that this is a value add asset. You're asking about the financing, but value add is tricky because you got to figure out how you're going to finance those upgrades. And so you might buy, like on this property, we need to put $4.5 million down on it, but we're wanting to do a $3 million renovation. And so if you're looking at the amount of leverage you can utilize. Well, if you just add the 3 million to the 4 million, all of a sudden you're looking at almost doubling your down payment. So we worked with the credit union and we created, first of all, we were able to get them to step up to 80% loan to value on the acquisition.
And were you at a 1.25 DSCR at like the time of acquisition, or were you below that and negotiating?
Oh, we definitely hit it for the first, the 1.2 or higher debt service coverage ratio.
On pro forma or on actual?
Well, so let me think this through, Gabe. So we did an as is and as completed appraisal. On our as is, we hit the 1.2 times debt service coverage ratio. I don't think that we had to stretch below that. If we were, once we haven't gotten to the line of credit that was utilized in this transaction. So that line of credit, that additional debt to upgrade the units, that was subject to us being able to move those rents. So the first thing we did is we were, the loan to value was supposed to be at 75%. That's as much as the credit union wanted to go. And then we had negotiated to get a drawdown line of credit to finance the renovations that would be used to upgrade the units. And
was that something that was part of the vision from when you first underwrote the deal, or did that happen after you saw the as built and as finished, as is and as finished appraisals, and saw that there was enough meat on the bone there to go after that equity?
When I first put it in escrow and committed to the deal, the analysis was bringing it up to average. We saw that it was deficient, it was underperforming. So to pass my underwriting criteria, which needs to be checked, and then we get into deal making. And as you know, we're kind of aggressive deal makers, so it usually comes with a level of commitment. And so you can't always fully extrapolate out the highest and best use. We just know that the identified, we're going to bring it up to average. This property meets that. It was after we were in escrow that we started playing around with, okay, where do we want to, what's it look like if we position it at the 75th percentile? What's it look like if we position it at the 85th? And so I landed on the 75th percentile. And if you go back and review that executive summary, you'll see we did the analysis on both of those. Here's what we think we can make, bringing this back up to average. Oftentimes bringing an asset to average, like anytime you're doing a value add asset, it's a blend between fixing management deficiencies, property management deficiencies, and owner. It's not always, you can't just blame the property management company. Management deficiencies is inclusive of the owner, the owner's decisions. Yeah. Is the owner putting the correct capital back into this asset? And then secondly, physical deficiencies, curing those, and then also physically improving the property. And so I find that coming up to repositioning properties to average is usually about 80% fixing management inefficiencies. It's just coming in and understanding, how to correct that. What should the market rents be? A lot of times they're simple fixes. Well, last year I got $900, so this year $1,000 should be good. Well, your neighbor's getting $1,400, so maybe you ought to just ask for $1,400 too. So it can be very simple. Once you're going above average, that's usually when you need to physically invest into the asset. And I often use new construction as the example. It's at the usually by design, the 100th percentile. It's the top rents in the market. And everything is physically superior. And the amenity package is usually superior. And so we look at that as the high water mark. Well, we're not going to be new construction, even if we replace appliances. We're just not going to have the right. Same amenity package. Why would a resident pay the same amount for our
over improving?
Yeah, exactly. So you land somewhere in between. What we're looking to do is to provide a product that is a lot nicer than average, but is more affordable than new construction. And so that's the segment that's the niche of the market of our offering. And so it was when we were in escrow that we realized this asset has all of the ingredients to be above average.
So go back to how you negotiated that. How did you get the lender to go to 80%? How did you get the lender to go along with the idea that we needed a line of credit to do the value add renovations?
Exactly. So we're in escrow. We're completing our analysis and due diligence on the property. So the first loan I negotiate, like with the lender, first we're talking about the acquisition loan and, to actually buy and close on the property. So that started at 75% loan to value, and that's what we were expecting. We were still in a fairly easy credit environment because we're in escrow in the fourth quarter of 2021. So we're not to the close. This was a 6-month escrow. So we're in fourth quarter 2021. Writing was not on the wall yet of what was right around the corner as far as the credit crunch and rising interest rate environment. So first we get a fairly traditional loan package put together. We're going to put 25% down. We're going to borrow 75%. We negotiate a interest rate. I was happy with the margin that we landed on. It was probably somewhere around 225 basis points above the 10-year Treasury yield. This was a stressful transaction because as we're progressing through this 6-month escrow period, we're listing properties, we're selling them, we're getting into exchange. To complete, reverse exchanges are great with the IRS, but you got to have the capital. So we're preemptively starting refinance activities on assets that we don't plan to sell so that we have some excess liquidity available to complete reverse exchanges. At the same time, so every time a property goes, we're successful in selling it, we go into 1031 exchange, our funds go over to the 1031 accommodator. That's tax exposure. If the subject deal blows up, you're facing recapture and boot on that. And so you're taking on more and more exposure throughout the process of getting from A to Z. At the same time, we come over the new year into 2022, and we've started in earnest on the rising interest rate environment. And so all of a sudden, loan negotiations are starting to get a little more stressed. But before we get to that, so let me back up just 2 steps. So we negotiate the acquisition loan. We show the lender our analysis and due diligence on why the asset and the property should be repositioned to compete at the 75th percentile. The lender agrees with us. They say, yeah, we think that'd be great. So when they order their appraisal assignment, they tell the appraiser, tell us what it's going to be worth, what it's worth as is, and then tell us what it's going to be worth subject to the borrower making all of these improvements and re-tenanting the units. The appraiser came in, very close to a similar opinion to us. So it met all the benchmarks. And so then we're talking with the lender about how to structure that loan. So the line of credit is ideal because we don't have to pay on it until we draw on it. And so we had about a $3 million renovation, $1 million on the exterior, $2 million on the interior. We're right around $20,000 per unit that we're planning to put into it. So we get that all hammered out, and they agree to do a drawdown line of credit that when it's meets its term, meaning when the 2-3 years into it, it's going to automatically roll over and just become part of our main mortgage and amortize out as a 30-year amortization schedule. So we're humming along just fine, and then kind of a light bulb goes off as I'm reading all of the updated documents, and I'm like, I thought that we were getting the full $3 million. The credit union was planning on doing 75% loan to value on the first, 75% on the drawdown line of credit. So I'm missing about $750,000 on that credit line that I thought that we were going to have. And at this point, we're halfway through the transaction. I know how much equity we have coming into exchange, and that was too big of a gap to fill. We didn't have enough time to get another $750,000. So we were able to come to terms that we would increase the loan on the first to 80%, and we would take that extra 5%, which was about $750,000, and we would apply it as the down payment on the second drawdown line of credit. And so we ended up getting, a blended loan to value.
Was that your idea or theirs?
That was my idea, but we were just negotiating it. I mean, they're not obligated to do it. Again, we're looking at what works for both for the lender and what works for us. They're only going to take on so much risk profile, but they want to do this loan. This is a good loan for them. They're a local credit union, right in their backyard. So certainly a two-way street. We got the appraisal done. There was excess on the appraisal, so there's a lot of things. I have found the first thing that your lender needs to decide is whether or not they want to do the loan. And again, it's much more of a user decision with a real bank or credit union. Like, they need to make that decision. How do we feel about the borrower? How do we feel about the asset? Once they've made that decision, I think of lenders as being kind of regulators to entrepreneurs. Lenders have their own regulators. They're in the same boat. So once they've made the decision that they want to do the loan, then a lot of it is, can we do this loan? Is it within our parameters? Are our auditors and regulators going to go, why are you doing a 30-year amortization? You should have done this at 25. And so part of it is being able to get your lender to talk to you and just be open about that, where they see the concerns, because then it allows you to work together. Okay, if A is not going to work, would option B or C make you feel comfortable with your regulators and still get us to where we need to be?
Yeah. That's an awesome example.
Yeah, no, it is.
And then the trickiest part about that whole transaction with the debt negotiations was that we were on a 90-day letter of interest, and it was a 6-month, it was a 180-day escrow. So we're at about January 15th, and our letter of interest is renewing. These things are non-legally binding until close, but the lender's reputation is on the line. So if a lender says you've got a 90-day LOI, it really needs to hit the fan before they're going to pull that off the table. Even banks that have less honor code, in my opinion, than credit unions, they're going to work really hard to honor that. But if they've hit the 90-day and interest rates have moved, then they kind of have an out. So we closed that loan at the interest rate that was negotiated in October, I guess it would have been 2021. We closed in March at that interest rate, but that was a little bit of an effort.
To say the least.
Yeah.
Yeah.
So,
you guys have other questions about this deal?
So was your negotiation with the bank, I don't have the extra $750,000 for this, so we need to change something if you guys want to do the loan?
No. I mean, we wouldn't have sale failed. We would have had to cut down on the amount of rehab. We could have do the rehab at a later date. So the lender wasn't in jeopardy of losing the loan. We weren't in jeopardy of losing the deal. This wasn't a hostile negotiation. There was a misunderstanding, miscommunication as to how much debt was on the table, and I was using it as an example of we were able to come to terms. And the reason that the credit union was willing to come to terms is that we had the lender was getting pushed a bit on their loan to value, their typical loan to value ratios. But this actually circles back a little bit, Gabe. We were not pushing debt service coverage ratio, and the as completed debt service coverage ratio had a lot of padding in it.
Yeah.
We had far exceeded the benchmark. So I find, so you think of a lender, you've got all these different overlays. You have loan to value, debt service coverage ratio, sponsor history. There are all these different underwriting criteria. A weak deal that's not going to pass is when call it the 5 main points to the lender. Is when all 5 of those are weak. So assets hitting 119% debt service coverage ratio, lender's minimum is 120. They'd like to see 130. Let's say the maximum loan to value is 75%. The borrower's pushing them at 75%. So it's hard to get any party to push to their maximum on each one. But if you've got a solid debt service coverage ratio, the lender loves the geography, it loves the management plan. Like, it makes a difference. They know that Corvallis is our backyard. They know that we have experience in Corvallis. We have other assets in Corvallis. So you've got all these different points that are strong in the deal. It's much easier to get to push one of them. And so in this one, it was we're needing you guys to help push loan to value on us, but we've pushed you 15% past your comfort zone, but we've got 30% excess, over on this one. And so they can take a global approach on that.
Gotcha. Well, we kind of cut him off partway through his story, dove into some deals.
We can get back into chicken farming in the second part of this episode.
Well, I had another question. So, like, as the people listening, like, you can tell Logan knows so much about financing, underwriting, and all these things. Like, how did you acquire all of this knowledge? Just from doing? You've mentioned, like, literature a few times. Were you reading books on it? Like, how did you come about to get to where you're at now?
The vast majority, I've learned live and through individual mentors. And what a common occurrence for me is I learned something the hard way, and then I can remember Jerry Fox told me like 5 times, watch out for that, or, you don't want to do that. And so, but it's just my personality to have to get my own crash course in it. So a lot of trial and error and just persistence. I mean, my brother and I have been very active in real estate. My motto is get rich slowly, as fast as I can. So we follow kind of the same business formula over and over. Sometimes it feels a bit monotonous. The first few times you do a certain type of deal, it's exciting, it's new. Then it becomes kind of boring. But I say this kind of jokingly, but it's 100% true because I keep track of it. Since I closed on my first deal, I've spent a cumulative 26 days. So first deal, this would have been back in 2008. I have been out of underwriting for 26 days since then.
Wait, what do you mean by that?
I haven't spent more than 26 days not in underwriting, meaning under the review of a bank, working on a refinance, working on an acquisition. Once I hit 30 days, I'm going to call that my 1 month anniversary of being out of underwriting.
So you're what we call a deal junkie.
So, but what I was driving at is that it's just been very consistent, and you learn through each deal you do in working with lenders, working with the parties on the other side, the principals, working with the brokers. And so that's been my greatest influence on me. And I've had some very good mentors along the way as well.
Yeah. Would you recommend to like people wanting to be like you and starting out just to dive into it and start learning from doing, or how should they go about it?
I think that's a loaded question because it depends on who you are.
Yeah. Were you selling eggs when you were 7 years old? You might want to consider doing what Logan does.
No, yeah, I think there's a lot to be said for diving in and getting your hands dirty. And I joke a little bit because I on one hand, I would consider myself a deal junkie. Like I do a lot of deals. Mm-hmm. I'll tell myself because it's a yin yang, like, you guys have experience, you've done deals. It can be very tiring, right? So finally it stops, you get off the hamster wheel. It's like, I'm going to breathe for 90 days. But then a good deal comes along 2 weeks later. It's like, well, I like that one. I'm going to move on. I've got the energy again, right? So I'm going to go. But at the same time, I'm also a very conservative investor. And I try to be methodical in controlling the deal size, only having so much exposure out at a time. What I mean by exposure is if I'm working through 2 value add deals, a third one may come along that I love, but that's too much exposure. Once those assets are stable, I'll move on to the next.
Trevor's learned this lesson the hard way.
Yeah.
Too many good deals at once.
Well, what happened? Everybody learns it because it's not like I haven't been pushed a little bit too far. Just luckily, I didn't let myself get pushed off the end. But you learn like, okay, that was too much. Everything became not so much fun when I added the third one in, and it didn't all go as planned. So you get reminder crash courses.
Do you think you just naturally learned how to gauge your risk profile at a given time, or did you have to sit down and be like, no, it's a capital number. It's an amount of units that I have to turn in the next 6 months. What was the hit that made it be like, oh, I don't like having to do 30 units in a month?
Yeah, you get influences from a lot of different areas. So my brother and I, we spend a lot of time talking about this stuff, and brainstorming it and deciding what our plan is. You get influences from your lenders, right? So like both your, private money lenders can be easier and can be harder. But each lender is coming from a different angle. So you have to, if you start getting out of line, like I've gotten into this, call it a cycle of demise multiple times before, where your liquidity is getting too low. It's usually getting low because you got too many transactions going, too many assets going through the value add life cycle. And when you have too many assets going through the value add life cycle, let's say that 20% of your portfolio that is value add, right? That's not stable yet. Well, it's sucking up resources from the rest of your portfolio. Beautiful tax benefits, but from a practical standpoint, that means you don't have as much spendable income either. So now your liquidity is low, your spendable income's low. I'll go talk to my lender about fixing this. Well, all of a sudden, you're not as desirable of a borrower, right? Like there is an adage, especially during like the Great Recession, everybody used to say, lenders the only people that can borrow money are the people that don't need it. There's a lot of truth to that. Oh, you got $10 million sitting in the bank. Here's all of our loan programs. It's like, well, I don't need your money. And the person that's run out of liquidity and their cash flow is getting low, they're wanting to get to that money to fix it. So you learn through that. You have to get yourself back out of that cycle. You have to be cautious to make sure that you don't get yourself below that threshold, because you need to make sure that you're a good borrower, a strong looking borrower, so that when you go to your lenders, you can get it. So anyway, I've learned that through live experience.
It sounds just like the paintball business. You're running low on cash, and you don't have enough marketable units.
We spent too much money.
We got to get some more product on the shelf, but we don't have enough cash.
Yeah. So are you tracking your like portfolio wide DSCR, your global DSCR?
Oh, yeah. I track, and believe me, I have to track it for my lenders. This is a full-time job. I probably put in 20 hours a week just reporting to lenders on what they want for their annual. And that reporting gets easier if you don't push the bounds, right? So it's when you're pushing, they want to look a little bit closer. Mm-hmm. But no, from a practical standpoint, we do. And now we have help, hired help so we got a lot stronger books, and our CPA does quarterly updates for us so that we can really see live. That helps us gauge where we're at, how much we can take on, how much we cannot take on. We track that from a performance standpoint, because real estate is not linear. And that's one of the first lessons you learn in real estate.
So explain.
Well, okay. So when you look at a performa, real estate performa, you can find one on a marketing package for when you bring a property to market, or you read an appraisal. It's going to have a performa in it. It's an income and expense analysis. That analysis, the time period that they're focusing on is 12 months, right? A performa is typically based off of a 12-month period of time. Here's the expectation. There'll be $100,000 worth of income, $40,000 worth of expenses, $60,000 in net operating income. Then the borrower can compute out what kind of debt services they're going to have, and ultimately what kind of spendable income they're going to have. But the data that goes into that is, let's say that the performa is for 2024. Okay, so we're in 2024. Well, if you're putting it together properly and the appraiser's putting it together properly, it's not indicative of what's actually going to happen in 2024. the analysis for one way to think about it is it's essentially averaged out over the economic lifespan of the asset. And economic lifespan is different than physical lifespan. So physical lifespan is how long is it physically going to be there. Economic lifespan is how long is the asset gonna economically perform. And typically multifamily is 25 to 30 years, which is why you can get a 25 to 30 year amortization on multifamily. Whereas light industrial, industrial might have a 15-year economic lifespan. It's essentially saying after 15 years, we don't know that this use, that the marketplace is going to support it. Maybe, it may, but it's kind of only how far out you can project. So when you're putting, I'll use an example. Take like a roof on an apartment building. So if that roof is at the end of its physical lifespan today in 2024, it needs to be replaced this summer. But you're not going to see a pro forma with a $30,000 roof expense. It's going to be diluted over the 25-year economic lifespan, and that might be, of its 30-year physical lifspan. And so it's going to go on into onto the pro forma as a capitalized, part of the capitalized
reserves.
Reserve, yeah, CapEx reserves. And
I don't see the $100,000 roof. I just see $150 a unit in reserve.
Yeah. So what it doesn't address is when in that 25, it's kind of an average of the 25 years. That's how you get the most accurate numbers. Because understand, you're trying to capitalize the value of the asset. So if you don't do the exercise, the analysis that way, then needing a new roof, well, it shouldn't take off $700,000 worth of value from the property, but if you deducted it on the pro forma, that's exactly what it would do. It'd drop your NOI by that amount. And it goes all the way into, so that's just one example with a CapEx, but think about renovating units. So at the vicinity apartments we talked about, I'm putting 20 grand into those units when we update them. That's new floor coverings, new kitchens, new bathrooms. So I'm going to get another say 15 years out of that unit, but it's all in the future. And so it works both ways. So what that's going to do is reduce the amount that needs to be allocated to CapEx reserves, but also to maintenance, right? So because maintenance, there's an intrinsic relationship between CapEx and reserves. And I usually coach brokers, put them together. Just make sure you come up with a gross number with them put together. Don't get too hung up on separating them out because you can allocate them into different spots. You put a new carpet in. Hopefully you'll get 7 years out of it. But if you need that new carpet this year, that means you're going to get it the next. It's going to be cheaper for the next 6 years. Remind me, Gabe, what got me on this example?
I asked when you said real estate's not linear.
Oh, yeah.
Yeah. So we can't, basically what you're getting at is we're looking at a snapshot in time, a very small window into the economic performance of this asset. And depending on where you land in that, you might be looking at this, but you don't realize there's either not a lot of additional CapEx coming or maybe there's a ton. And that's part of your due diligence is to underwrite and figure out where
exactly.
that what your renovation
is about what we track. What we're tracking in our portfolio. So exactly. So I track the global, so asset by asset, and then globally the pro forma NOI, and then we track what's actually happening live because we might look excellent pro forma wise, but if 2024, particularly when you're a value add investor, that's what you got to be extra cautious about, because if you've got too much actually scheduled for 2024 and 2025, well, that's all right now. So irrespective of what your net worth is looking like, are you going to be getting checks?
Sometimes you underwrite a deal and you look at it and you go, man, this is really mismanaged. They're not making any money. But the reality is they're putting a lot of money back into the property. Other properties you look at it and you go, wow, this thing's a cash cow. But you go and you look at it and it's run by a slumlord.
Yeah.
They never spend a penny. So the numbers look great. But what you're going to have to do to right that ship's going to cost a lot of money.
100%. When I'm talking to brokers or partners about pro forma, constructing an accurate pro forma, because if you don't construct it accurately, it's garbage in, garbage out. That is one of the examples that I use. So a simple one is and you actually see this in marketing packages. Oh, we got an 8 cap apartment. It's like, I don't think so, because you're at 300,000 per unit and everybody else is at 300,000 and their, cap rates are 6. And so you start diving into the performance and how they got to that. Well, where's your property management? Oh, they managed it themselves. Okay, so I'm going to pay you $300,000 more for your property because you manage it yourself. So again, the performa is the marketplace's expectation for expenses. And then there's an inverse relationship with the example you just talked about, Gabe, with. So if a property owner, okay, we're going to sell this asset, we're planning to sell it in 2025. So let's get it looking good between now and then. So let's replace these appliances as they're getting older, and we're going to update the floor coverings. So what does that do to the value of the property? It increases it when they sell it. And then conversely, okay, we just had a unit turnover. Floors are trashed, cabinets are trashed. Well, let's just get a trashy resident in there and we'll get away with it. That doesn't increase the value of the property. It reduces it. And that's why...
But makes the numbers maybe look better.
And really what it is that historical numbers, it's understanding that just, it's one of the data points, but it's really misunderstood. I have a rule, and I know I've told you this rule, because lenders don't always get this either. I will not let a lender have the historical operating data of a property that we're buying until their letter of intent is issued and the appraisal is ordered.
How do you get away with that? Because we're doing that right now, where they want the historical.
Weird thing.
I won't let them do it.
We just tried that.
You make your own data. He creates the executive summary and he sends it to them. And
yeah, we do that also. So like we give them all that, and then they're telling us right now, like, no, we want to see the historicals. Like we gave them 2023 data. They want 21, 22 before they start doing anything with us.
Sure. Well, so first, let me explain why I won't do it.
They don't know how to read it.
They will misinterpret the data.
Yeah.
And they are going to make me pay $3,000 to $6,000, $7,000 to hire an appraiser on their behalf to correctly interpret the data. So I like to wait till that happens. I don't want them to misinterpret it ahead of time. There's a reason that they go through that exercise, and the misinterpretation has to do with not understanding how the analysis is done and what those historical numbers mean. Okay, so we get that concept. So now you're asking me, well, like, how do you
actually get them to accept that?
Well, I don't know. I guess I don't know if they're not
charming.
motivated enough.
You have to be charming like Logan.
Yeah,
Sounds like you're a commodity to the lender. That's what you said you gotta do.
So they can't negotiate a deal blind. So I put an executive summary together for every property, whether there's a lender involved or not. There's almost always a lender involved, but the executive summary for me is my underwrite of it. And I found that if I'm disciplined in doing that, I catch a lot more of my own mistakes or assumptions. So it forces me through the checks and balances and the exercise. And then I feel very good when I get to the end. If it passes, I'm confident. And I need to do that exercise because you got to be confident if you're going to go out and be a deal junkie. Like if you're going to negotiate and you're going to start putting non-refundable earnest money, so you get that exercise done, you feel good about it. Now you can focus just exclusively on trying to get the negotiations done and not be asking yourself like, well, do I actually want this property to go? So in that executive summary, you're doing the performa analysis, or I am doing the performa analysis. And, performa analysis, again, it's to get to what the scheduled NOI is, net operating income for the property. So I let the lender see that. They see it includes the rent roll. Here's where they are today. Here's where I think they're going to be. Then you go through all of the income and expenses. Here's the taxes, insurance, and then you're supporting that data. So taxes are pretty easy. Just look them up at the county. Hazard insurance, go get a couple of quotes. property management. This isn't rocket science. Most lenders have an expectation of where it is, but you get a couple of bids from property managers. So you go all the way through it, and then I make an allocation for the maintenance and turnover and CapEx. So they get to see that, but that's not the historical data. And so then you're negotiating for a letter of intent. And the letter of intent, has an assumed property value in it and an assumed net operating income in it. And that's what the executive summary is addressing. Here's my assumed net operating income. Now I'm hypothesizing that based off of the net operating income, property's going to appraise out for $3 million. And so then I start that one gets the lender's arms around it. So I do their underwriting for them. So then I put in the loan I want for that. I say I want to borrow $2.2 million. I want this interest rate. It's based off, here's how I came up with that number. You don't have to tell them that. Sometimes I don't, but often I do. Yeah. I'll take the prevailing rate and I might tighten it up by 10%, come across. It's a negotiation. And but I'm basically underwriting the loan for them so that they can quickly look at it and say, good collateral, meets our debt service coverage ratio, meets our loan to value ratio. Credit departments wants me to get 275 basis points over the 10-year treasury. Borrowers hitting me at 225. But now I've got all the ammunition to go back to credit and tell them this is a loan we should want to do. Again, risk reward ratio fits all these things. Can we get this borrower this, we want his business. Can we give him the 225 basis point spread?
And you have the track record of all the executive summaries you've built. I think you have about a 99% accuracy when it comes to your underwrite. So when you're handing a lender your executive summary and your Logan DeVos, they look at that like they're getting a pre-appraisal up front. So if you can build an executive summary that has some clout behind it, you can probably say, this is all we're giving you until we get an LOI, and then we'll show you the trailing data from there.
Yeah, that is helpful, particularly with my private money lenders. So I always share with them, usually our exit is a finance event. 9 out of 10 times with a private money lender, my exit is a finance event. So I always share with them the actual appraisal when we refinanced it, because I want them to compare that to what we told them it would appraise for. And it does help. And I have these conversations with them. And what I'm usually driving home in the discussion with them is not, look how smart I am. I have an ego like everybody else, so I am thinking that. but the more poetic way and what's more important, what I'm driving home with them is that I'm telling you my opinion in earnest. I'm not buying this property that I think is worth $1 million. And I get to buy it for $700,000. So this is a good deal for me. And I'm going to pitch you that it's worth $1.5 million so I can get you to give me $1 million on it now. I don't remanipulate the executive summary. It's my raw underwrite. And that's what I want to get across to the private money lender. And that's why I want them to see the results after the fact, to consistently remind them I'm not over pitching you. And I haven't had a substantial misfire. It's always valuation is an art and a science. So I'll have missed it by a few points below, and sometimes come in a few points above. But
so when you're going to perm and you're prepping them, you've taken hard money, you've built your summary, you've financed the deal. Private money lender says, yeah, we trust you. We've seen your track record. Now you're going to go to perm. When you take that new data to the lender, now you've been operating it for a period of time. Are you giving them example of here's where it was when I bought it and here's where it is now? And this is why I think we've hit our business model. It's time to go to perm. Are you still withholding trailing data? 24-month, 36-month, or at that point when you've hit the perm, do you say you're going in for your perm financing? You say, here's how it operated 3 years ago, 2 years ago. I bought it. Here's where it is today. This is the loan that I want.
Yeah. So I'm not afraid for the lender to have the trailing data. I feel like we made it, like I do follow that rule. But the main thing is I just don't want to have to talk them all through it. It's much easier once they get the appraiser involved. And I've had deals where the delta is very large. Like, so think to yourself, why are you going after the value? Like, what makes it a value add deal? It's like we talked about before. It's a blend between physical deficiencies and management deficiencies. So I could go black and blue talking to a lender about all those management deficiencies. It's hard when you can't see that. It's much easier for the lender to go, oh, Powell Band's valuation came to the exact same conclusion you did, and here's how they, explained it. So it's not like it's a deal killer. I'm just in the habit of not sharing it, and the lender doesn't need it. So what got me started on that executive summary, and I can ramble, is their letter of intent is all subject to the appraisal, the appraised NOI, and the appraised value. And with some commercial banks, and I haven't had this experience with credit unions, the other reason that I don't like to have them look at the historicals is there's a lot of banks that they'll start manipulating that data as well to try to get to a different loan term. So in other words, this is my perception. I believe that they agree with me on the NOI, but they're going to drive for an NOI that's lower to try to come up with a number on this LOI so that they can make their job easier with credit and get a better rating on the loan. And I won't use any bank names, but I've found this with multiple commercial banks. So one way to poetically avoid that is if you read a lender's LOI, what's it say? Maximum loan to value, 70% or 75%. Minimum debt service coverage ratio. So I don't want to argue over this is the real thesis. I don't want to argue right now over what the NOI is going to be or what the value is going to be. I want to come up with the loan terms, the loan to value, ratio, minimum debt service coverage, and then, a lender does typically like to have an actual loan amount on there as a cap, so I'll negotiate that with them. But let's stay out of the weeds of how we get there until the appraisal.
It's just an LOI.
Yeah.
You're just trying to get a preliminary commitment from them so that you can frame your investment strategy.
Yeah. And I can tell you, Trevor, that it's certainly you might not be able to drive. It's harder with a new relationship to drive all of those deal terms, right? So it doesn't mean it will get easier when you're going back to that lender to do it again. You might have to fold a bit on that, but it ultimately also comes down to how much they want to do that deal.
So I think you're going to keep going.
No,
it's going to be our longest episode.
I was going to grab it. Yeah.
I think this has been a wonderful episode. So we've got Logan DeVos, former chicken farmer, paintball entrepreneur, real estate mogul with us today. This has been an amazing episode. Thank you for joining us, Logan. We'll come back. I don't know what we'll talk about because we just talked about a deal for a long time. Maybe we'll talk about chickens again. But
there we go. No, I appreciate it, guys. Thanks for letting me get on and yabber away. I don't get a lot of opportunities.
We'll do it again. We will do it again. All right, guys. Thanks for joining us on Deal Junkies. We will see you next time.